Welcome back. As you know, it's very sad. Yesterday, we finished the book from Tony Turner. It was a great book, and now we're done. So we've graduated from this book, and we will now be starting this book. This is also a day trading book, of course. As of right now, that's really all I'm going to be reading are day trading books. This one is by Justin Kuepper, Kuepper. I don't really know how to say his name, but anyway, this one I have not started reading this one at all. So we are literally going to start this one from the very beginning, and we will finish it together. So table of contents, this one is going to go over the market, of course. What is the market? Where does the money come from? How does the market work? Key market players, prices, patterns, and trends. That's going to be in the first chapter. In the second chapter, chapter 2 is going to go over the truth about trading, why trade, why day trade, the good news, the bad news, managing expectations, realistic goals, most will lose, minimum bankroll, one big or many small, whatever that means, profit goals, and trying to stay calm, myth busting, secret to success, you don't need much money, day trading on autopilot, and personality cult. So that's getting kind of deep into each chapter. Chapter 3 is going to go over trading psychology. Chapter 4 is going to go over what to trade. Chapter 5 is going to go over tools of the trade. Chapter 6 is going to go over charting and patterns. Chapter 7 is going to go over technical analysis. Chapter 8, how to pick a stock. Chapter 9, trading plan. Chapter 10, money management plan. Chapter 11, just general trading. Chapter 12, trading systems, and chapter 13, risk management. So that's kind of that's the overview for what this book is going to be going over. I'm gonna have to learn how to say this guy's name, but later. I'm not a big fan of introductions. I'm not. Yeah, no, we're just not. Yeah, no, I'm just not gonna do an introduction. We're just gonna jump into it. I don't know if that is correct or not, but I'm certain that anything that they are speaking about in the introduction, we will cross that path again while reading the book in its entirety. Okay, so yeah, I guess I'm excited to see what this book is all about in terms of merit. So let's jump in. All right, so chapter 1, the market. Most people are familiar with the market in a layperson's sense. When they go to the supermarket to buy groceries, they understand that the store is essentially a place where buyers and sellers meet to exchange goods or foods. The picture becomes less clear when one turns on the television and sees media pundits discussing the market's performance. It can be unclear what market they're talking about or how the stock and bond markets work. In this section, we'll look at the markets from a conceptual standpoint and give you an overview of the functioning of financial markets such as stocks and futures. So what is the market? Suppose that a grocery store in Florida expects the price of orange juice to rise significantly over the coming month and wants to stock up on its supplies. The grocery store should go to an orchard and request 15,000 pounds of orange juice, but it would be difficult to settle on a fair price and find a seller that would be able to supply the full amount. As a result, the grocery store might have to identify multiple sellers, buy orange juice at different prices, and then try to calculate its future costs. In addition, the grocery store would have to coordinate delivery and incur storage costs for all of the orange juice, or carrying costs, in other words. The futures market makes buying 15,000 pounds of orange juice trivial. By purchasing a $20,000 futures contract for 15,000 pounds of orange juice to be delivered the following month, The grocery store can conduct business as usual and still know that it will be able to offset any potential higher prices with the profit derived. The grocery store could then turn around and sell the futures contract for a profit on its expiration date without even taking delivery of the product. In the end, the grocery store's bottom line would be the same as if it had actually accepted the delivery. On the other hand, suppose that a farmer is looking to sell 15,000 pounds of orange juice. Not only would the farmer have to coordinate all of the buyers, he would also have to come up with the cash to grow the oranges before realizing any profit. Again, the futures market makes selling 15,000 pounds of orange juice very simple. The farmer puts the contract up for sale, receives the proceeds from the contract, and then supplies the goods at a future time. The transaction makes the farmer's income more stable and enables him to receive a fair price. The futures market, the stock market, and other markets are mediums for facilitating transactions between buyers and sellers. Instead of individuals and companies having to negotiate small private transactions among themselves, financial markets provide a greater transparency so that everyone knows they received a fair market price, which was created by matching a given product supply with its demand. In most cases, these transactions take the form of an auction to ensure the best possible price for both parties. The electronic nature of modern markets also helps lower transaction costs and gives anyone with an internet connection access to trading contracts, assets, securities, and other products worldwide. What does this mean for day traders? Using the same orange juice example, suppose that a day trader notices an unusual spike in demand for orange juice futures. The trader could purchase the contract for $20,000, wait the course of the day for the price to rise to $21,000, and then sell the contract for a $1,000 profit or 5% gain all within the same day. In doing so, the trader purchases the rights of 15,000 pounds of orange juice and can sell the rights to a different party for a nice profit. Day traders help make markets more efficient by including all relevant information on the price of an asset. Drawing on the above example, suppose that a farmer in Brazil was selling the orange juice futures contract without knowing that there was a spike in the U.S. demand for oranges due to a drought in Florida. The market ensures that the information about the drought is automatically included in the latest price, since the day trader would have closed the price gap very quickly. As a result, the farmer in Brazil knows that the current price reflects all of the information available to the market, even if he himself does not possess all of that information. These dynamics highlight just how powerful global markets have become. Day traders, long-term investors, and end users come together to determine fair prices for everything, from commodities like orange juice to companies like Apple. For day traders, there are literally hundreds, if not thousands, of different markets to trade in, and therefore countless of opportunities to gain profit. These profits are derived from capitalizing on changing expectations and speculating where the market prices are headed based on the information available. So where does the money come from? The first question that many aspiring day traders ask themselves is, where does the money come from? At first glance, the market seems like a zero-sum game where there are winners and losers. This is true for markets like futures and options, where there's always a winning and losing side to every transaction. However, other financial markets like the stock market are not necessarily zero-sum games. A company whose stock is consistently rising can produce many winners and no losers. The stock may never come down to its original levels if the company is able to continue generating revenue and profit growth. Such dynamics make the stock market a powerful tool for wealth creation in society, as economies drive wealth creation at a faster rate than inflation destroys it. The corollary to this is that there are instances in the same markets when everyone loses. During the 2008 economic crisis, one might wonder where all the money that had been lost by banks and investments had gone. The answer is that the price the market is willing to pay for such assets can simply decrease, and the assets become less valuable, even if nobody makes a single trade. After all, any asset is only worth as much as someone is willing to pay for it. A second great example of this phenomenon has to do with what happens when a company goes bankrupt. The money invested wasn't necessarily taken by executives, it simply disappeared along with the expectations that the investors had had for the company's future. Okay. The good news is that stock prices have trended higher historically due to the economy's positive rate of growth, which in turn has made the stock market a powerful tool for wealth creation, at least for those who participate in it. As mentioned earlier, futures and options are two instances in which the market does function as a zero-sum game. A farmer making $20,000 by selling the rights of 15,000 pounds of oranges that he plans to grow next month will lose out if prices rise to 25,000 by next month, whereas the grocery store that purchased the futures contract will pay $5,000 less than the market price that month. While there are some exceptions, most options contracts operate the same way. Someone selling the rights to their stock at a certain price will lose out if the stock rises above that price before the contract expires. In the end, market prices are determined by supply and demand. When more people want to buy an asset, the asset's price increases and vice versa. Rumors, the news, and one's own earnings, among other factors, influence a trader's perception of a company, commodity, or asset. These perceptions in turn influence supply and demand, and therefore price changes. How does the market work? Suppose a day trader places a market order of 500 shares of Apple stock after determining the price is likely to rise in the future. Although the shares appear on his computer screen nearly instantly, there are actually a number of different steps that need to be executed in just milliseconds to make this happen. Day traders should familiarize themselves with these steps so as to ensure that they are getting the best possible prices and to prevent costly mistakes. Stocks are originally created or issued in the primary market via public offerings, such as an initial public offering. In crypto, these are called ICOs, initial coin offerings. Once issued, these stocks are traded in the secondary market between traders and investors. This trading process doesn't involve the company at all. Large institutional traders usually dominate initial public offerings and then sell shares to smaller retail traders, although retail traders can also secure some of these shares with the help of their brokers. Most day traders start their interaction with the market by communicating either online or by phone, with a broker trading in the secondary market. Since trading is a regulated activity, brokers are necessary intermediaries who, in exchange for a fee or commission, buy and sell stocks or other assets on behalf of individuals or institutions. Instead of communicating with their clients personally, most modern brokers have online platforms that execute instant transactions, thus making trading a largely hands-off task that is still highly secure and regulated. Brokers buy and sell stocks on behalf of their clients, either on an exchange or over the counter. In general, most trades occur over exchanges like the NYSE, NASDAQ, NYMEX, although many derivatives trade over the counter and deals made directly between the buyer and seller rather than through an intermediary. Exchanges are responsible for matching buyers and sellers. In the past, specialists handled the process on a trading floor where loud shouting and lots of shoving used to take place, with tons of paper lying around. Most modern exchanges have switched to electronic processes in order to improve efficiency and enforce controls. Exchanges maintain lists of buyers and sellers in what's known as an order book. On one side, there are bids, which represent prices and amounts that buyers are willing to pay for a security. On the other side, there are asks, which represent prices and amounts that sellers are willing to accept for their security. Matching engines are used to determine which orders can be fulfilled. When a bid and an ask are matched, a new market is made, and the trade price becomes the security's new price. The entire process works like this. A day trader places an order of 500 Apple shares with his broker. The broker's system combines this trade with other orders of Apple shares from other clients' accounts and submits a big order for the stock to an exchange. The exchange checks the order book and fills the buy order with the best prices available. The exchange then sends the shares to the broker. The broker divides up the shares among its clients, and the number of shares that each day trader ordered appears on his screen along with the transaction details. Still, knowing how the market works is not enough. You also need to know who is involved in all of the processes that take place. Key market players. Being a powerful tool for wealth creation, the market has attracted some of the world's brightest minds. According to the WealthX Billionaire Census, finance represents the single largest source of wealth for the world's billionaires. Among these billionaires are corporate executives, market makers, institutions, hedge fund managers, and finally, individual retail traders. It's important for aspiring day traders to know how all of these individuals and institutions interact before jumping into the ring with them. Issuers are undoubtedly the most important players in the market. They create the securities that everyone else trades. By selling stock, companies raise money to support their growth and create liquidity for existing investors, including company founders. By enabling them to sell some of their shares, companies can also influence the market through stock buybacks, dividends, and mergers and acquisitions. In commodities markets, producers fill a small role by generating generating oil and other commodities that are sold in the market, and can influence prices by changing the supply. After issuers and producers supply the raw material, market makers are responsible for keeping the market for these materials moving. Market makers compete for orders by displaying buy and sell quotes for guaranteed shares. By starting out with a block of shares, they profit by simultaneously buying stock at the bid prices and selling stock at the ask price. Market makers must maintain continuous two-sided quotes within a predefined spread to generate profit. By constantly executing these small trades, they accumulate a profit over time and ensure that the market is liquid. That is, that trades can be easily executed at fair prices for everyone. For example, suppose that IBM stock is trading with a bid-ask spread of $96.80 and $96.90. A market maker could simultaneously enter an order to sell IBM stock at $96.90 and an order to buy them at $96.81. If a trader somewhere decides to sell at $96.81, the market maker has made the spread by selling their shares at $96.90 via the existing ask and buying them back at $96.81. The market maker makes a profit of 0.09 per share. Assuming that someone bought the stock at $96.90 before a seller offered it at $96.81. These types of trades ensure that any investor can buy IBM stock whenever he wants and know what the price will be within a reasonable degree of certainty, or with a reasonable degree of certainty. Market makers are incentivized to be involved in as many trades as possible so as to maximize their profits on the basis of the small profit they receive on each trade. They are also contractually obligated to contribute bid and ask orders to the market. Since brokers are looking for the best price for their clients, market makers with the tightest and fairest quotes tend to generate the most profit. Even though such sentiments are common in many retail day trading circles, market makers are not in the business of ripping off their clients. Doing so would only jeopardize their relationship with clients. In the 1950s, individuals owned over 90% of the stock in the U.S. corporations, but institutional investors have since taken the reins. These days, only 30% of individuals control their own stock. A growing number of people now rely on mutual funds and other investment firms to manage their stocks for them. The number of mutual funds has grown from just 100 in the early 1950s to more than 10,000. These funds alone have attracted trillions of dollars in investment capital, and this does not even include pension funds and other forms of institutional investment. Institutional investors include large organizations such as banks, pension funds, or insurance companies that make substantial investments in these securities. These investments are often made through financial institutions, including mutual funds and hedge funds, which trade the money on the investor's behalf. Such groups tend to control the majority of the trading volume on most exchanges, although the bulk of that volume comprises long-term investing rather than short-term trading. However, there are many groups that use active trading strategies like high-frequency trading or HFT operations. According to a 2010 report by the U.S. Securities and Exchange Commission, HFT operations accounted for more than half of all U.S. equity trading volume in 2009. These groups use sophisticated algorithms to rapidly trade securities and profit from small discrepancies in security prices. The use of HFT has fallen since 2009, but the practice continues to generate a significant amount of trading volume in the U.S. equity markets. Regulators have been working hard to even out the playing field by limiting the abilities of these institutions to unfairly profit off individuals. For instance, some HFT institutional traders have been accused of front running. They would see an order for a given stock placed by an individual, move to the front of the line using high-speed data connections, buy the stock at a lower price before the individual gets to it, and then sell the stock to him immediately for a profit. In such scenario, the individual loses out because he pays a higher price than he would otherwise have to pay for the stock. Retail traders, which include day traders, constitute the smallest group in the market. These traders generally work for themselves or in a partnership with other traders. They trade using their own capital or other people's money. Although most day traders in the past were institutional traders, the advent of direct access brokers and powerful communication tools has made it possible for anyone to compete. Day traders who use other people's capital are known as proprietary traders, or prop traders for short. Prop traders generate profits for themselves by taking a cut of what they make off the capital provided by hiring a firm or individual. Modern regulations have also prevented many financial institutions from having prop trading desks so as to prevent potential conflicts of interest. Typical transactions between these parties may look as follows. An entrepreneur comes up with a great idea and decides to start a company using his own money. Eventually, he decides that it's time to raise money to fund the company's growth and let someone else take over the reins. The company goes public via an IPO for $1 million. The entrepreneur then sells his shares for cash to the investment bank that sponsored the IPO. The investment bank goes on a roadshow, selling the stock to market makers and other parties for a profit of $1 million, thus making the company worth $2 million. The market maker then creates liquidity for the stock, and retail traders are able to buy and sell easily. The above example raises the question, how do day traders and other parties know how much to pay for a stock? Prices, patterns, and trends. Let's say you were shown a stock on a chart, or let's say you were shown a stock chart and asked to determine whether or not to buy the company's stock based on changes in its price over time. While it might seem ludicrous to make an investment decision based on nothing but price, prices themselves can actually tell a detailed story about a company. Based on past movement, price statistics are able to predict where prices are most likely headed. Patterns in price fluctuation could also provide insight into the market's underlying psychology, as rising stock may indicate a successful company that is steadily growing, or it could be indicative of a promising young company on the verge of growing rapidly and generating a large windfall. A falling stock may suggest that a company is facing growth problems or is in danger of going bankrupt. Similarly, a stock that is starting to trend lower for the first time in years may suggest news issues within the business and herald the beginning of the end. A company whose stock is starting to trend higher for the first time may have undergone successful restructuring, and the stock could lead to higher profits in the long term. The most important element for day traders in any market is the price, which is usually defined at any given moment as the price of the most recent successfully executed transaction between a buyer and a seller. A company's fundamentals should not really matter if the market is efficient and if all current information is already included in the stock price. In order to run some statistics and gauge the market's psychological state, the only thing that really matters is where the price is headed and perhaps how the price has moved in the past. How do you determine where prices are headed? On a micro level, future prices are determined by looking at the order book, the existing bid and ask prices. If there are more ask prices than bid prices, it means that there are more sellers than buyers and the price is likely to decrease, and vice versa. Large gaps between bid and ask prices signal potential price volatility to come, as they indicate a higher level of indecision when it comes to what is considered a fair price. High-frequency trading is a form of day trading that looks at order books to determine where prices are headed in the next 2 seconds. On a macro level, prices tend to form patterns and trends based on the underlying psychology of the market and the performance of the asset in question. A company reporting consistent growth will likely see prices trend upward, whereas a commodity seeing less demand will likely see its prices trend downward. Price patterns can also be very telling when it comes to getting a feel for the market sentiments. Most retail day traders focus on these elements when trying to determine where prices may be headed over the coming seconds, minutes, or hours. Trends play a particularly important role in the life of a day trader. Prices of stocks either trend one way or the other, especially within longer time frames. Trends occur in the market because of herd behavior, which occurs when individuals in a group behave without centralized direction. It is a phenomenon that has been studied by scientists, including Nobel laureates like Vernon Smith, Amos, oh my goodness, it's Tversky. We're just gonna spell it Tversky, and Daniel Kahneman and Robert Schiller. Taking advantage of these trends can enable day traders to increase their chances of placing successful trades. Finally, day traders prefer liquid markets to illiquid or less liquid ones because the price in liquid markets are more certain. It would be very difficult to pinpoint a buying price for a stock that has a wide bid-ask spread and is not traded in days, and even more so to sell the stock on the same day. A highly traded stock like Apple or popular index exchange traded fund ETF, on the other hand, might have a tight bid-ask spread, which is to say that day traders would be able to purchase the stock at a well-defined price and would be able to count on exiting the position with equal certainty. That said, illiquid assets are and should be priced based on existing orders and demand rather than current market prices, which may be out of date. Okay, quick recap. The market consists of buyers and sellers exchanging assets on a centralized exchange. By connecting supply with demand in one spot, prices become fully transparent, liquidity is greater improved, and regulators are able to put rules in place to protect both parties. The supply side of the financial market consists of publicly traded companies which sell stocks in an initial public offering and other offerings, commodity producers which mine, grow, or otherwise produce raw materials for sale, and other parties that put up assets or rights to assets for sale. Market makers are responsible for creating liquidity on a day-to-day basis by buying at the bid, selling at the ask, and profiting from the bid-ask spread. Without market makers, it would be difficult for buyers and sellers to connect in a financial market. Institutional traders consist of hedge funds, mutual funds, and other parties that buy and sell large quantities of assets for various reasons. Given their large amount of capital, they account for the vast majority of trading volume. Retail traders consist of individuals who buy and sell small quantities of assets in order to generate a profit. Although individuals used to constitute the bulk of the market, they have been eclipsed by institutional traders and are now very much the minority. There are many types of financial markets, including stock markets, commodities markets, and foreign exchange markets. In addition to trading different assets, traders have access to financial derivatives such as options and futures. Some markets, like options and futures, are zero-sum markets. Other markets, like stock market, are not zero-sum, since the market can rise consistently over time, generating profits for all. In general, given the upward bias, it is easier and less risky to trade in positive sum markets than to trade in zero-sum markets. Many traders use price patterns and statistics to gauge the market psychology at a given point in time before determining the optimal time for buying and selling. Trends provide the best opportunity for traders to profit because prices are moving in a predictable direction. Most traders adhere to the saying, "The trend is your friend," when trying to profit in the financial markets. Cool. All right, cool. So that's the end of chapter 1. I think that was pretty cool. This is a very detailed breakdown of, it sounds like what's going to be pretty much everything, like everything that goes into the market as well as trading. So again, I am excited. Even though it's going over very basic information, I feel like I still definitely learned some stuff in detail that I didn't have as great of an understanding of before. So good shit. All right, I will see you next time for chapter 2.